Here we're going to turn to the consumer, and because we're talking about the U.S. consumer, the first place to start is debt and credit, and how is that shifting? Because one of the things that we've been discussing is that the savings cushion was higher than expected, and we talked about it on Friday, where we have those charts again just to factor in and build that thematic view on why that matters so much. But when you look at consumer credit, came in higher in August than expected at $32.2 billion versus the expectation of $25 billion. Shown in the chart, revolving credit jumped at an 18.1% annual rate because, again, people are borrowing more to maintain lifestyles. Now, when you look at just where that leads us and how we're sitting right now, that's a massive problem given where rates are and how rates continue to climb higher for credit card debt, which is, again, going to drain people's ability to continue to borrow at the same level on the credit card side, and how they're going to have to use savings to try to pay down a lot of that credit card debt. So now when you look at non-revolving consumer credit owned and securitized, it has gone higher. We're well above the pace that we had established back in 2016. And then the revolving consumer credit owned and securitized, it is blown through the 2020 highs, the pre-COVID highs. And again, that is only going to get worse because that's looking at billions of dollars. So we're coming up to about 1.16 trillion. But now think about how in the pre-COVID world, when the 10-year was below 1.5%, you were paying 14% on your interest rate on your credit card. Now that the 10-year is at 4%, where are you paying? Is it 22%? And that's again going to eat into the ability for people to continue to spend at these levels. Americans are having difficulty paying bills, and again, this is a key piece when you start looking at. It got easier in after money started getting paid out. People were now back elevated. Forecast, if you look for by the New York Fed for household spending growth over the coming year, dropped sharply, notching the steepest 1-month decline since June 2013. So the expectations, if you look at the Fed, which has been looking at a lot of the similar data we have, they see a big drop in spending growth, which is what we've highlighted as starting to really emerge in September and now accelerating as we go into October and obviously through the remainder of this year. And a lot of that is with this reduction of about $300 billion in the perceived savings cushion, where when you start taking that out and you look at the revised number, you see that we're starting at a lower level. But now when you extrapolate that out and factoring in the savings rate, which is at the lowest level it's been since 2008, you can see that the excess savings gets drawn down aggressively faster when you look at the dashed, which is the pre-September 30th revision, and then post-revision. You can see just how quickly that volume and that value in the bank gets pulled out. And again, you can see that we've hit that pivot point where now we're really starting to get that acceleration. There's also that mental capacity. Everyone has that number where once they dip below that in savings, they start to feel uneasy. And it could be fairly elevated. And again, that is where we're going to continue to see and hit as people prepare to spend money. Like my wife started Christmas shopping because there were some deals. And within 3 toys, we have 3 children. So within 3 toys, we were over $100. And you had to get to 100 to get $25 off and whatnot. And additional, this was in Kohl's, so Kohl's cash. But when you look at, 3 toys, $100, like that is just, the numbers become staggering. And when we were going through our budget for Christmas, we're looking at it where the budget hasn't really changed. It's probably gotten a little bit smaller. And now it's like, well, how much stuff are they going to get? Because, kids, they like to open, they like the act of opening presents. So do you buy more smaller things or just try to get more quality over quantity? And this is the conundrum, which is going to be a big problem, which is why we see a lot of these pressures accelerating into the holiday season. And again, that was just my example, but I think other people can feel what I'm feeling, and then obviously it continues to show up in the data. Now, when you look at non-farm payrolls and the hiring plans, this is where there's still downward momentum on payroll, but you're still elevated, which is why when you look at what the Fed's going to do, when you look at the Fed activity, they still have room to continue to raise rates, especially when you start factoring in other pieces. So September's job report now means 9 straight quarterly gains for non-farm payrolls, 9 straight quarters. We haven't gone negative yet. So everyone thinks the Fed's going to pivot, but some of the biggest things they look at from an inflation perspective are still elevated and growing, and from a jobs perspective, still running hot. So why are they pivoting? Like, where? And I know everyone's looking at stock market price, and they're like, oh, that's why. It's like, but then when you look at job leavers constituted 15.9% of unemployed individuals in September. That's the highest share since April 1990, which still signals confidence among quitters, and they likely believe they can find a better paying job. So you still have a ton of people quitting their jobs in what I would look at and say is a very precarious position from an economic standpoint, but they still feel confident they can get a better job, better paying job, which shows that there is still a lot of froth, obviously, within this market. Multiple job holders made up 4.9% of total employed as of September, unchanged from the prior month, but still largest share since February 2020. So again, people are trying to carry multiple jobs to bring in that additional income, given how high prices have gone. Payroll strength has weakened in terms of number of industries adding jobs, but current level is not yet consistent with major drawdowns in the past. So here's where you're starting to see some of the softness when you look at, again, the diffusion on the payrolls. You're coming back into some of that historical norm. But then when you look at unemployment rate versus the non-cyclical rate of unemployment, which is deemed kind of the natural rate, we're still below the natural rate. So again, all of these pieces just support the Fed continuing to raise rates at this juncture. Then when you look at interesting on the housing side, it's interesting to see home builder sentiment, which is the blue, and existing home sales, the white, plunge as construction payrolls continue to climb above pre-pandemic peak. So even though everything is slowing, you still have a very elevated price that you have to pay people to keep them on site. Similar to 2005, 2006 in terms of lead-lag relationship, but with notable differences. And I think that's the biggest piece when you go forward, is that we're coming back to these levels, and then look how steep the drop-off was in payrolls on the industry construction side. We see something similar happening, which again hasn't shown up yet, but that is something that is going to be kind of that tailwind again for maybe some additional construction and some of that support in general. So then when you look at median per Redfin, median down payment for U.S. home buyer has almost doubled since 2019, since July 2019, from 32,917 to 55,000 in July of 21 to 62,500 in July of 22. So again, that hurdle rate continues to go up, and in order to buy a home, given where rates have gone, you have to put more and more down on the down payment to keep your monthly payment lower. Median down, and then when you look at median sale price, is still up 7.4% year on over year. It's coming down, but obviously, again, you're seeing a lot of this froth, which is supporting more activity because asset prices are still so excruciatingly high. Monthly mortgage payment using median existing home price with a 20% down payment. You can see just how high it's gone, which is why in order to keep that monthly payment low, it's not 20%, it's 40, 50, maybe even 60% down to keep that. And then the mortgage credit availability index is coming down because, again, people can't get the same credit they were able to get in the past because of a lot of these things that we have seen pivot. Then average 30-year mortgage rate has risen by 3.7 percentage points over past year, largest increase since November 1981. Again, factoring back to why mortgage rates and mortgage credit availability has come down so aggressively and so hard, keeping those pressure points in place. So that's what we have for you in the US. In the next segment, we're going to go deeper into Europe and some of the things that are happening within the UK as well.